How's it going, everyone? So today we're going to go over Q2 2026 real estate market update, going over interest rates, affordability, and competition. So who am I? I'm Kobe Smith. I'm a realtor and developer. I'm the team lead at Chateau Seekers at Keller Williams Capital Properties. I'm known for professionalism, integrity, and strong negotiation skills. I'm also the president of the Greater Baltimore Leadership Association. I sit on the board of the Greater Baltimore Urban League and the Greater Bethesda Chamber. And my mission is helping people build wealth, create opportunity, and turn dreams into reality through real estate. So the purpose of today's session is where interest rates are today and why, how rates affect affordability and competition, why housing shortages matter in this market, and what buyer, seller, and investors should expect, and how to position yourself strategically in 2026. So, a big misunderstanding about rates. Most people think lower rates make buying easier. The reality is, lower rates increase demand, more buyers re enter the market, competition increases quickly, and negotiation power decreases. Affordability improves, but leverage changes. So, where are rates and why? Current 30-year mortgage rates are approximately around 6.875% as of May 11th, 2026. Rates remain elevated compared to pandemic era lows, as you can see in this graph. Still within more historically normal ranges, though. So why are rates still elevated? It's because of strong labor market, it's because of inflation and consumer spending, and housing supply constraints. The ADP reported private payroll growth above expectations. Hiring activity has improved from earlier slowing down, and resilient labor market reduces pressure for aggressive rate cuts. When it comes to inflation and consumer spending, higher gas prices and inflation continue affecting consumers. The Federal Reserve remains cautious about cutting rates too quickly. When it comes to housing supply constraints, existing home inventory remains limited. New home sales increase partly because supply remains constrained. Demand remains active despite higher borrowing costs. So, higher than pandemic lows does not mean historically high. Rates today are heavily influenced by inflation, employment data, Federal Reserve policy, bond market performance, and housing supply shortages. So, interest rates timeline, mortgage rate environment over time. So in 2021, 3% mortgage rates, pandemic era stimulus, and historically low borrowing cost. In 2022, we saw a rapid rate increase. Inflation surged, and the Federal Reserve remained rates and raised rates aggressively. In 2023, 2025, we saw an elevated rate environment. Borrowing costs remained higher while inflation cooled gradually. And in 2026, we're seeing but, well, moderating, but still above pandemic lows. We're seeing rates easing somewhat, but not expected to return to 2 to 3% levels. So, how are rates affecting monthly payments? Small rate changes have big payment impacts. For example, a $500,000 loan, a 7% rate would equal $3,327 a month. A 6% mortgage would be around $2,998,000 a month. And a 5% mortgage would be around $2,684,000 a month. Lower rates improve affordability and increase purchase power. So, the housing shortage problem. We still don't have enough homes. Maryland and DC continues facing low inventory. New construction still lags demand, and housing supply remains constrained. Entry level and missing middle housing remains undersupplied. Low rates and a housing shortage market amplifies competition. If you look at this chart here, you could see that homes needed, you could see that we need around 30,000 homes per year to keep up with demand. Right now, we're doing closer to 25,000 homes, not keeping up with demand. So what happens when rates drop? Lower rates change market behavior. For buyers, lower monthly payments, more competition, faster timelines, less negotiation power. For sellers, more buyer demand, more showings and offers, stronger pricing environment. For investors, lower borrowing cost, increased competition, and fewer obvious deals. So why higher rates sometimes favor buyers? Higher rates can create opportunity, less competition, more seller flexibility, more negotiating leverage, more credits and rate buy downs, better terms for prepared buyers. Sometimes the best opportunity happens when fewer buyers are active. So what happens when rates fall later? Buying early can still benefit buyers. Potential refinance opportunities later, lower competition entry points, more negotiating leverage upfront, potential appreciation if demand increases later. Waiting can become expensive if prices rise faster than payments fall. So, currently in Maryland and DC markets, we're seeing in Maryland specifically medium home prices around $447,000. The average days on market is around 35 to 48 days. Inventory level is still limited, and year over year appreciation is around 4.6% year over year. In DC, we're seeing median home prices around 590,000. Average days on market receiving 46 to 71. Inventory levels are increasing, and year-over-year appreciation is mixed, slightly negative in some segments. Maryland and DC price trends. For Maryland, prices stabilized in many sub-markets. Strong homes still move quickly. Strategy matters more than timing. In DC, neighborhood level variation remains significant. Walkability and lifestyle premiums remain strong. Condos require pricing precision. So, buyer psychology versus market reality. Emotions versus strategy, pretty much. So, common buyer reactions are I'll wait for rates to drop. Prices will crash. I miss the market. Market reality is timing is difficult to predict. Supply remains constrained, and preparation creates leverage. Strategy matters more than the headlines. So, strategic buying scenarios. Comparing two markets, scenario A versus scenario B. Scenario A, lower rates and higher competition. That means more bidding wars, higher prices, less leverage. Scenario B, higher rates and lower competition. That means better negotiation power, seller credits available, and less buyer competition. The cheapest market isn't always the lowest rate market. So this is some real buyer examples. Comparing two markets. Buyer A versus buyer B. Buyer A is waiting for lower rates, bought at a lower rate, faced bidding wars, paid 30K more, waived contingencies. Buyer B bought at a higher rate, negotiated seller credits, got inspection contingencies, refinanced later, and faced less competition. Which of these scenarios do you find is better? Transit adjacent neighborhoods. Areas positioned for long-term demand. Silver Spring, Capitol Heights, Noma. Silver Spring, you have red line, mark, purple line access, strong renter and buyer demands. Capitol Heights, you have blue line access, transit-oriented redevelopment underway. Noma, you have Union Station and Metro access, employment-driven demand. This is stuff that you should be looking for when you're picking an area for investment or for your first home or for just your next home. Areas with infrastructure investment. Public investment often precedes private growth. New Carrollton, Anacostia, and White Oak. New Carrollton, you have the Mark, Amtrak, Metro redevelopment. Anacostia, you have streetscape and housing investment. White Oak, you have life sciences and mixed use growth. Path to progress locations. Growth driven by fundamentals, not hype. Langley Park, you have purple line impact. You have density and affordability shifts. Denwood, you have metro access, gradual reinvestment. Suitland, you have federal employment base, and you have under the radar pricing. So, what buyers should do right now? Buyer strategy in today's market. Get fully prepared before shopping. Understand payment comfort ranges. Focus on long-term affordability and be prepared before rates shift. Prepared buyers move faster and negotiate better. What sellers should be doing right now? Seller strategy in today's market. Understand buyer psychology. Price strategy and strategically for current conditions. Maximize presentation and marketing, and prepare for shifting competition. What should investors be doing right now? Underwrite conservatively. Watch borrowing cost carefully, and focus on long-term fundamentals. Understand cap rate compression. So, key takeaways from this whole presentation. Lower rates increase competition. Housing shortages amplify demand. Timing alone does not create success. Strategy matters more than headlines, and preparation creates opportunity. So next steps from here, pretty much what we need to do is schedule a one-on-one strategy session to review specific goals, timelines, and financial positions, to create personalized plan based on today's market conditions, to identify opportunities and risks unique to your situation, and to leave with clarity, direction, and next actions. Here's a link. Use this link to get on my schedule so that we can sit down and have a conversation. It could be virtual, it could be in person. Have a conversation about what your goals are and how we can best reach them. Like I said at the beginning of the meeting, I'm Kobe Smith. I'm a realtor in Maryland, DC, and I hope this presentation helps give you a general idea of what's going on in the market in Q2 of 2026. And if you guys have any more questions, feel free to email me, put something in the comment section, and let's schedule a one-on-one so we can get you to where you want to be and reach your goals.